Let's bring in now the Chief Economist at EY, Oceania, Cherelle Murphy. Cherelle, thanks for your time. You've had a little while to digest the RBA decision and the statement. Rates are up. Where to from here?
Good morning, Kieran. Yes, rates are up and it looked like they're going up even further from here. The Reserve Bank, when it changed its forecast in that statement on monetary policy on Tuesday, put in place some pretty big upward revisions to both the underlying and the headline inflation rate over the next year or so, suggesting that it won't get back down into the target band really for some time through to 2027. So that's not good news, of course, and it does suggest that the RBA is facing quite a bit of pressure here to get things back to where they should be. And that's including the fact that within their forecast, there's already 2 rate hikes considered in there. So I think, we've got at least another one coming.
So when we're talking about these capacity constraints, as the RBA put it in its statement, the Treasurer repeatedly talking about the increase in private demand, but the capacity question goes to whether there's enough room for that private demand. That's the key issue, isn't there?
That's right. I mean, the capacity constraints across the economy refer to labour, they refer to equipment, they could even refer to finance, availability of finance. But across the economy, we're certainly seeing that being problematic. And of course, the private and the public sector sometimes are competing for the same resources. And so the public sector is to some extent using up some of these resources, which makes, of course, it harder for the private sector to get access to them. And sometimes the public sector has better terms to offer. For example, it can offer workers longer contracts, or it can offer perhaps higher prices. And so that's where we see, I guess, some of this conflict between the private and the public sector.
In terms of the rate rises, is there a risk that the RBA might need to reverse all of the cuts of last year?
You certainly wouldn't rule it out because, I mean, it hasn't been a very a sharp cycle on the downside. So, to take up 3 rate hikes as we go in the other direction, really isn't a huge ask. As always, it will depend on how the economy responds to this first rate hike. Of course, that will slow down things a little bit further as we look into the next 12, 18 months. It's an imperfect science, of course, but we definitely will likely see some effect there. Plus the fact that we've got the Australian dollar appreciating at the moment, which does tend to help inflation. Of course, it puts deflationary pressure on the economy. That's one of the other transmission mechanisms of monetary policy, and that should help too.
Yeah, indeed. Plus the message itself, isn't that right?
That's right.
You've got the move on rates, but the expectation that there might be 1 or 2 more in itself sends a signal.
It certainly does, and it's a really powerful tool that the Reserve Bank has. It's simply talking about what they see as the pressures in the economy, and of course the media reporting of that. Sometimes we even see that as soon as the following weekend in auction clearance rates, for example. A few people kind of maybe pulling back from the market. So yes, it's definitely a powerful tool.
Can I ask you about the speculation around reducing the capital gains tax discount? What's your view as an economist as to whether this helps or hinders supply in terms of the housing market?
It's really more of a demand side element in the sense that it discourages investors relative to first home buyers, but it is only a relative change in the pricing over a long period of time and how they might consider house prices and whether or not it's attractive to get into the market. So it really doesn't help the supply side of the economy very much at all. In fact, it might even damage it if it did cause investors to pull back from buying, and those investors were then likely to rent out those properties. So it can impact the rental market in some ways. However, in terms of getting some intergenerational equity back in, it might be seen to be quite a good thing because, clearly there is a bit of a divide between investors and those at the front end of the market who are trying to get their first home. And that's, I think, what's motivating the government to at least put it out there and into the media to see if people like it or not.
Yes, indeed. So it looks like the symbolism of that, the message to younger voters on the one hand versus whether or not it would actually be that effective on the other. And as you said, when supply's the main game, could it actually be an adverse impact in terms of supply? That's the question. Do you think as well, Cherelle, just finally, if there were to be any move here, would they have to grandfather any change? What's your sense on that?
Uh, I think it's probably quite likely. Otherwise, they do face upsetting existing property owners, of course. But that becomes a real political question, whether or not they're willing to take that risk. Of course, if they didn't grandfather it, then the revenues that or the expenditure the tax expenditures that they would save would be much larger. So it becomes a question of, is this a change for the future, or does it apply to previous property owners? I'm sure many of whom would be quite upset if they did see that change. However, we are facing a fiscal future which is quite dire, and in these circumstances, it is quite likely that the government perhaps should take some fairly bold moves.
Cherelle Murphy, Chief Economist at EY. Thanks. Talk to you soon.